Good afternoon, ladies and gentlemen. Happy August 24th, 2017 to you all. And of course, welcome to today's presentation, the third part of our four-part series this week on vertical spreads. Today we're talking about the management techniques of spread positions. We're going to discuss our preferred adjustments for credit spreads and debit spreads. And looking at some of the positions, of course, we opened on Tuesday. Actually, those are profitable because we used the power option search to find positions that matched our specific criteria. And for bullish and bearish spreads, so those expiring next week that we looked at, are both very profitable right now. But we're going to take a look at what if we did the opposite of those two spreads and what might we adjust. Those of you who don't know me, if you haven't been joining us for our webinars this week or before, my name is Mike Chupka. I'm the Director of Education here at Power Options. Of course, Power Options is a patented suite of search and analysis tools for self-directed options investors. And we support over 23 of the most commonly used option strategies, tools to find, compare, analyze, track, and manage your positions. And Power Options has been in business since 1997. And I've been with Power Options and trading options since about 2001, so about for 16 years. So welcome to part 3 of our presentation. Thanks for sticking with me this week. Today we're going to try to look at how we can adjust losing spreads into winning spreads. And of course, we're also going to discuss trigger points, what we might look for first in order to realize, do we need to adjust this position? All right. So, why is management important? Well, the other day when we were talking about criteria, I showed the results of bull put credit spread track record that had about a 56% return over a 2-year period that Ernie and I have been back testing and working with to maximize the performance. Of course, only 8 of those positions were losers over 140 trades. It's about a 94% success rate over the 2-year period. But even if you have a strong track record of performance, that is never a guarantee of future results. The market is dynamic and ever-changing, and what looked like a sure thing, what might have even looked like a 95% probability trade, may go against you. And if you were looking for a high probability spread in the 90 or 95% range, you're probably looking at a 10 to 1, maybe 12 to 1, maybe 15 to 1 risk-reward ratio. We can't afford to take the full loss and really wipe out 15 previous trades. So we want to look at ways to manage those spreads that are moving against us so we can avoid the full loss as well. Now, in yesterday's presentation, we talked about things of looking at a spread. So we're talking about a credit spread. We're looking at certain ranges of out of the money with the probability, what your expectations should be for a spread. And we saw that, going 7 days out in time, if you wanted a 75% probability or higher, you might have only been 2% out of the money. But if you go 2 weeks out in time, you might be 3% out of the money. If you go a month out of time, that might actually be 7% or 8% out of the money as more. But when looking for a bullish spread, we talked about standard criteria that we might use. Naturally, I'd want a stock to be trading above a 50-day or 20-day moving average, whichever you prefer. We looked at the 20-day because we're looking at shorter term trades, 1 week or 2 week out. But of course, if I go monthly, I might use the 50-day. In general, I want a probability of success, a probability above in a bullish spread or a probability below in a bearish spread of 75%. And we use some technical indicators too, in addition to the stock being above the 20-day or 50-day moving average. We wanted a positive MACD crossover, and we want it to be a decent range out of the money or more. Now, I know that many of you are using your own criteria. You have your own method of trading credit spreads, debit spreads, or more. But what's key here is that a trigger points for bull spreads are really any spread, whether it's credit or debit. The criteria that you use to enter the trade, should be the same criteria that you would use for a trigger. If I open a bull put credit spread, I would search on Power Options for spreads that have a probability above of 75% or more. That would roughly equate to a delta of around 0.25 or less for the short option. The pivot point That's the focal point on our spreads for management and for triggers. Now we know the stock's going to fluctuate while I'm in the trade. But think about this. If you're doing a credit spread and your trading plan is to look for probabilities above 75%, would you ever open a spread that has a probability of only 60%, or would you consider that too risky? Many of you, I know, follow not other services, but you've read other education and seen other market educators out there who teach spreads with you should only open a spread if your delta of your short option is less than 0.3 or less than even 0.2, looking at more of an 80% probability range. Would you ever open a spread following those rules if the delta of the short option was at 0.4? No. So while we're in the trade, if my probability drops down to 60 because the stock is moving against me, or the delta goes up to 40, that's a trigger point. It might be time to manage the trade. The technical ones, if I'm looking for stocks originally that were above their 20-day moving average on a bullish spread, and I wanted a positive MACD crossover, some of you might use stochastics, which is perfectly fine. Some of you might use Bollinger Band breakouts, which Ernie and I tend to use as well. But if those are indicators you're using to get into the position, if that changes during the time you're in the trade, even if it's only a 5-day trade using weeklies, or if it's a 14-day trade, or even if it's a 30-day trade, if I'm in a bullish spread position and the stock reverses and it drops below the 20-day moving average and has a negative MACD crossover, that to me is a double verification. I would never enter a bullish spread if I saw those two on a stock chart. So why would I stay in a bullish position if now it looks like the pattern has initially changed and it's moving from bullish to bearish? Or if I was in a bear position where I originally looked for stocks under the 20-day or 50-day with a negative crossover, if it changed and the MACD went positive and the stock moved above the 20 or 50-day moving average, two of my indicators are broken, the verification is there, it looks like my stock is now going bullish, I would need to consider closing out the position or adjusting it as well. So what are we talking about? Now here is standard view of our stock chart, BABA, that we looked at for the bull put spread on Tuesday. Okay? We got in on Tuesday, but when we ran the search, we saw a recent MACD crossover and the stock was going positive and it moved above its 20-day moving average. Okay, so this is a good point of entry for a bullish spread. But now let's say today it changes and we're seeing this chart. Now this is actually for Home Depot, but if we were in the trade and we saw the direction change, it dropped below the 20-day moving average and then we see a MACD crossover, well, to me this again is a double verification that the stock is going bearish on the position. Whether it's related to earnings, but we talked yesterday how we would avoid that to begin with because we didn't want any surprises. But here we see a double verification that I would look to maybe adjust or manage the position if my sentiment is changing. Now, this of course is based on the criteria I mentioned yesterday and what I use in my personal account for the positions. But just keep in mind that the criteria that you use for identifying stocks for a bull or bear spread, if that criteria changes during the trade, look at it as a fresh position. Would you enter a bull put spread or a bull spread at that time, or would you enter a bear spread? If it doesn't match your criteria for entering a position at that time, you may want to consider adjusting it. Another common approach for adjusting spread positions is to base it off of the spread itself. This can be very tricky, and it's also has to be a little bit different than what you might use as what you'd consider a contingent stop with a stock position, for example, or even a long call position. One of the great things about credit and debit spreads, we know the maximum return up front. We know the maximum risk up front for any bull or bear vertical spread. So one thing to consider when adjusting the position, you knew you wanted to make, let's say, 50 cents of net credit, and you knew your risk was, let's say, $4.50. You made 50 cents on a 5-point spread, roughly an 11.1% return. Well, one way to consider a trigger point is based on the spread itself. If the cost to close the credit spread is 3 or 4 times the credit you received, so if I took in 50 cents on a bull spread, the stock starts to move against me, my liquidation cost is $1.50 or $2, or half the maximum risk. If it was $2.25, I might consider closing the position. Okay. Now on a debit spread, you paid a debit to get in. That's your maximum risk. So if I did a debit spread where I paid a debit of $4.50 on a 5-point spread, still an 11.1% potential return. But if the cost to liquidate the debit spread is 50% or less than the initial debit, so if that cost to close drops down to $2.25 or lower, I'm at a 50% loss. I might want to consider closing the position. Or if the debit is, again, 3 times the maximum profit. You can use either or. It depends on your personal preference and your management. Now, a lot of you are probably trading other positions such as long calls. You've probably traded long stock. And before you traded options, when you're in long stock, you might have followed the IBD rules of Bill O'Neill, I believe, where you'd look to close the positions, a stock, if there was a 7 or 8% decline. Of course, in spreads, we're using leverage. I can't use something that low to close the spread if I'm losing 7, 8, or 10%, because when I open the position, I'm already probably at close to a 7 to 10% loss with just the slippage between the bid and the ask. I'd be getting closed out of every position. I know a lot of investors who trade long calls or long puts, speculating on a market movement one direction or the other, might put in a stop at around 30 or 40%. That's also difficult to do with a spread position. You know, if I opened that spread with a $4.50 maximum risk looking to make 50 cents, well, a 30% loss of $4.50 might be triggered if there's only a 2% or 3% down day in the stock, which can happen very often. You can also see a loss based on the premium or based on the maximum risk we're talking about here if the stock doesn't move, but there's a shift in implied volatility for some unknown reason or some speculation on the security you're trading. If the implied volatility pops up, you might be at that 3 times or half the percent loss without the stock even moving as well. That's why it's more tricky, or trickier I should say, to put lower percentage contingent orders or limits on the spread itself. Okay? Because it might trigger very quickly and you might find yourself closing out of more spreads than you wanted to that would have ended up being profitable. But I know many investors do this and they're successful with it. What's better, 3 times or 4 times? Well, in general, I'd have to say 4 times is, assuming that sometimes positions fall against you or move up against you if you're in a bearish spread, you might trigger that 3 times your initial credit or maximum profit quickly, but then it settles down and you still be in a profitable trade. So giving yourself more cushion, the 4 times might be better. But you want to decide for your trading plan itself which trigger is best for you. As you can tell, personally, I tend to look more at the criteria used to enter the trade than basing it off, my trigger points, basing it off of 3 times the credit received, 3 times the maximum profit, if it cost me that, or half of the maximum risk. I look for the trends with the SMA, double verification with the MACD, or if the probability and delta have shifted, but everything kind of goes hand in hand. If some of those are going, then the others are probably going too. Now on Tuesday, when we introduced credit and debit spreads, we looked at a bull put credit spread on BABA, which was the first stock chart I showed you where above the 20-day moving average, and we saw that positive MACD crossover. And we entered a bear call on CMG, which met the bear call screens. And both are profitable right now. But on Tuesday, what if we went counter to the criteria and reversed the spreads? Meaning, what if I opened a bull put on CMG and I opened a bear call on BABA? Okay? Sean posed a question. He says, if our risk in the trade is 2%, so I'm assuming he opened a credit spread, and the monetary risk on the credit spread only represents 2% of his total portfolio value, and I'm prepared to take the loss, can one of the strategies be that we let the trade run whatever happens? Yes, Sean, that's personal preference. Okay, that really is. But let's get into the management techniques that we're going to discuss. That could even be considered one of them. I didn't write it up, but sure, if you're comfortable with the loss initially, that could be a way to go. But I'm going to comment more on that in just a little bit. Now, let's take a look if we had opened a bull put credit spread on Tuesday on CMG, which was actually a bearish position and had our bearish criteria. On Tuesday, with CMG trading at 308.59, I could have sold to open the 1st of September, next week's expiration, 300 strike put at 165. At the same time, I could have bought to open the September 295 put at 90. Right? So we would have taken in a total net credit of 75 cents on our 5-point spread. Maximum risk, difference in strike prices minus the net credit, so it would have been 425. Our percent return, 17.6%. Pretty good for a 9 to 10 day trade. Now the factors at the time, I wouldn't have opened this, but let's take a look. The factors at the time, the other criteria, the probability of the stock, the probability of being above 300 was at 70.2%. It would have gone 75. And the delta was around 0.29. I'd like to be 0.25 or below, but I just use the probability, not the delta. I put that in there because I know many of you use delta. Right? But it's still at a 70% probability of success, delta under 0.3, 17.6% return. Now current values, it bounced around this morning. As I was putting this together, I wanted to be as current as possible, so you'll see some stock changes. But when I was originally looking at this morning, CMG was trading at 299.35. It had moved against us. It was just below the short put. It ended up going back up to 301 and 302. But that's okay. So where are we at now? Well, short option probability is down to 48.2% above. That's a check. It's below 60. The short option delta is at 0.51. That's a negative 2. I really wouldn't want it to go below 0.40 perhaps. Spread liquidation value was at 205. So to buy to close the short put and to sell to close the long put, it would have cost me 205. I still keep the 75 cents, so we're at a $1.30 loss. But this is 48% of the 425 maximum loss in the position. So I'm pretty much close to that 50% range as well. Now I'm not going to talk about the technical criteria. I wouldn't have opened a bullish spread on CMG because it had the opposite criteria of what I would look for. But here we are in a position where most of the criteria we would use as a trigger point have been met, and it is below our short put strike price, so it's probably time to adjust. Short option dropped below, the probability is below 60 and the delta is below 0.40. Above 0.40. The stock was already below the 20-day and a negative crossover. The cost to liquidate is pretty close to 3 times the maximum return. We took in 75 cents, so about 225 is 3 times the maximum return, which is equal to 50% of the maximum risk, or 52% of the maximum risk. And the stock has dropped within 1% of our short strike price and below. Okay, now those are the triggers that we generally look for, personally, and it's also based on the structure of the trade itself. One of the ones I mentioned here is a stock within 1% of the short strike price. And I sold a 300 put on CMG. 1% of that is $3, so if the stock's at 303, I might have considered managing it, starting to move against me. I only use the 1% rule if I'm looking at a sort of a 20 to 30 day trade, 3 weeks, 4 weeks or more out in time. Because as we saw before, looking for that 70-75% probability on a 1 week out trade from yesterday, that's about a 2% range out of the money. Well, 1%, that's only a 1% movement on the stock. If I'm using weeklies, I'm looking more at around 0.3% or 0.5% to the short strike price, whether it's the short strike price on the bull put or the bull call or the bear call or the bear put debit as well. Another trigger point, of course, might be bad news. You're in the position, the volatility spikes because something comes out. A new lawsuit was introduced. There's rumors of a boardroom or CEO ouster, something along those lines. Rumors of a merger, which I'm in a bearish spread. There's rumors of a buyout. That might really hurt me if the buyout's high. And your stock might not move. But of course, you want to always pay attention to the news. That's something that might trigger the idea to adjust the position. All right, so we're focusing on the bullish there, but the bearish triggers will be pretty much the same. Remember, if I entered a bearish trade, it's because the stock was in a downtrend below the 20-day or 50-day moving average, and I had seen a negative MACD crossover for a good entry point. So trigger for a bearish, well, double verification. Stock goes above the SMA 20 or the MACD goes to positive, I might consider it. Same thing, probability changes. I would have opened a bearish spread with a probability below 75% or more. So if that changes to 60 or starts to move lower, that's a trigger point. And of course, if you set it based on the spread, liquidation are 3 times the premium. All right. So, bull or bear spreads. Here's the 7 techniques that we consider to adjust a spread position. I know there's hundreds of those out there. Sean even introduced a new one. If you're practicing proper position structure and every spread in your portfolio doesn't represent more than 2% of your total portfolio value and you're comfortable with that loss, you can just let it go and see if it goes profitable after it moves against you. However, if you opened 20 bullish positions, bullish spreads, which each represented 2% of your total portfolio value, and all of a sudden a black swan event occurs, well, if all of them start to lose, you're risking a lot more than 2% of your total portfolio. You got 20 positions risking 2%, you're closer to 40%. Management might be key to take any further losses. Okay? So let's just review the 7 techniques. Let's call it 8. Technique 0, do nothing. We'll call that technique 0 because we're not going to consider anything. We're going to do nothing. You've got proper position size in place, so you say, I can let this spread get wiped out. I've only lost 2%. Do nothing, the 0, we'll call that. All right, so then adjustment number 1, liquidate the position for a loss. It's hard to do. You might still have 7 days, 8 days, 10 days left on the spread. It's threatening your short option in the bull or the bear. You're considering management, but you know what? I've got 18 days left to expiration. I think the stock's going to stabilize. We can outthink ourselves, but liquidating for a loss and moving on is always an opportunity. Number 2, common. Most of you might do this if you've started trading options and you started with covered calls. You think the covered call goes against you, roll down. Roll the position down. Same thing. Bull or bear. Roll the position out in time and to different strikes that are further out of the money for your credit spreads or further in the money for your debit spreads. You've decided to stay with bull puts. You're bullish on the market. Stock starts to move against you. Move it down. You've been bearish on the market, but something happened and good news came out on the stock, such as Home Depot, which looks bearish. Maybe you've been trading Sears for years with bearish positions as it's continued to flop. But a good news comes out and it suddenly pops up even before earnings. Okay, so you want to stay bearish on that position. You think this is a fluke. Close the bear spread, move it to higher strike prices, and further out in time. Number 3 is highlighted with an asterisk. Why? Roll the short leg down 1 strike. On Wednesday, I mentioned that part of the criteria we use and part of the setup that I use in my positions, my spread positions, is if there's dollar strikes available, I use 2-point spreads. If the stock only offers 2.5-point strike differences, I'll use a 5-point spread. And if the stock only offers 5-point differences, I'll use a 10-point spread. Why? I want to leave 1 strike in between for the opportunity for this management. Think of our, in the bull put credit spread, the stock starts to threaten my short put strike price. buy to close that short put, move it down one strike. Don't touch the long. I'm still in a bull put credit spread, yes, with a lower return, but now I've got a higher probability and a deeper cushion against the stock. Adjustment number 4, close the short and leave the long open. What do I mean by that? Well, starting to get threatened, stock's moving against you, you close the short put or you close the short call, bull or bear, you close the short option and leave the long open. So in a bull put credit spread on CMG with it 299.35, I'm going to pay a high premium to close the short put, but I leave the long open because my sentiment is completely changed and the stock falls. I have infinite profit to the downside. Or in a bear call spread, I have infinite profit to the upside. Okay. Number 5, adding the opposite spread to create a condor, a butterfly, or broken wing butterfly. They all get lumped in together. Okay. So what are we looking at here? I've got a bull put spread on CMG. The stock drops down to 301. I want to increase my lower break even. So I sell a bear call that's out of the money and get another dollar so net credit. I lower my break even. I'm now in a neutral position. But there's pros and cons with that too. I've increased the potential return. I've increased the moneyness on the trade. Give myself a cushion. But there's other problems. Instead of opening the iron condor, if your sentiments change, close the initial spread you're in and open the opposite. I was wrong. I got to admit it. The stock moved against me. It looked bullish. It matched the criteria I used where 5 of my other spreads I opened at the same time are all going up, but this one's coming down. So instead of rolling down and trying to catch a falling knife and staying in a bull put spread on a stock that now looks bearish, let me close that bull put spread and open a bear call. Or close my bull call debit and open a bear put debit to get back to following the new stock trend, stay in position. And then number 7 is the pendulum adjustment. It's a way to move from a bull to bear or a bear to bull with just one leg. All right, Sean, you said rolling the short leg down by one strike will cost money for this adjustment. Yeah. Don't worry, this is not the whole presentation. I'm introducing the 7 or 8 right now to you. Now we're going to take a look at each one and the benefits and the pros and cons of each. Real market prices as of 11:40 this morning. Well, 11:35 this morning. And we're going to see these in action. Okay? So here's our threatened bull put spread. On Tuesday, sold to open the September 300 put on CMG. And we bought to open the 295. CMG only offers $2.50 strike differences. I took the 5-point spread, so I have one strike in between. We get a reasonable return, 17.6%, reasonable net credit for a 10-day trade at the time. Lower probability than we want, but this is just for example's sake. And again, the current situation, stock's bouncing around between 299 and 301, threatening our short put. The short option probability has dropped to 48%. That's one of our triggers. Short option delta below 0.6, one of our triggers. Spread liquidation value is close to 50% of the maximum risk, another trigger as well. Now, as I mentioned this morning, the stock was bouncing around between 299, 298, 302, and 303. So when I took this screenshot, I was at 302. I'm still in a profitable trade, but I am below 1% of my short option strike price. Remember, that would be at 303. So here's our spread. We've got 7 days left. Even with the stock moving up to 302, I'm still within 1% of my short option strike price. The delta is at 0.38, and the probability is at 62. So I'm very close to both those triggers as well as the liquidation value. But it's bouncing around. We've got some problems here. Okay, so what might we do? When I saw it at 299.35 this morning, it moved below my short put. My first instinct is I'm at 48% loss. Maybe I just liquidate the spread. The current debit to close around $2.205, 47 to 48% of the maximum risk. Well, let's be honest. No one wants to take a loss. No one wants to take a 47% loss on a spread. This position, remember, we had a 75-cent net credit with a maximum risk of 425. We're pretty much at about a 6-to-1 or close to it risk-reward ratio. A little bit less, about 5.8 to 1 risk-reward ratio. If I allow it to go to full loss, if the trend continues and it moves down below 295 in the next 7 to 8 days, I'm at 100% loss. I take the full loss of 425. I just wiped out 5 or 6 similar trades with similar net credits taken in. If I close now and only take the 47 to 48% loss at $2, I've only wiped out 3 previous trades. Okay? No one wants to take the loss, but again, sometimes it's better than taking the maximum loss. And remember, think about it this way. Before you liquidate the position, before you do any adjustment, when your triggers are hit, before you just go in and start looking at the adjustments and start playing with the numbers to see what works, analyze the stock as a new position. I'm in a bull put spread that's going against me. If I practice proper position sizing, hopefully the maximum risk on this trade only represents 2% of my portfolio, which I can stomach. But again, we want to find ways to turn losers into winners. But I need to analyze the stock first. What happened? Why is CMG at $299.35? I'm going to look at the stock chart with fresh eyes if I didn't have a position and consider what would I open now? Would I open any bull or bear position against this stock? And if your answer is you just don't know, you don't know what's going to happen next, you don't know why the stock's been falling, it's going against everything you originally researched, you can't find any news on it, you're not sure what's going to happen next, that's when you liquidate the spread. Why try to continue to manage a position you're unsure based on your criteria and your analysis of what's going to happen next? Don't take the chance. Get out with a small loss, not the full loss. Find a new position and move on. All right. Roll number 2. Adjustment idea number 2. Roll the position. Keep your strategy. You're a bull put credit spread trader. You're a bear call credit spread trader. You stick with bulls puts. You stick with bear calls. You stick with bull call debits. That's fine. The stock moved against you, but maybe it just moved against you because of the market. We looked at bullish positions. We found a bullish position on BABA. Well, we know over the 6, 7 day, 14, 30-day time period that we're in our spread trade, the stock has got to fluctuate. Something happens geopolitically. Someone rattles their sabers across the seas and threatens us here in the U.S. or threatens one of our allies or does anything, and the market pulls back. The indexes drop down 0.5%, stocks fall 2 or 3%. Well, now your bull put's being threatened. But you say it's just related to the market. In a bear call, all of a sudden good news comes out and the markets move up. You know, the rising tide lifts all boats. Your bear call is threatened. But the stock you're looking at is still bullish or it's still bearish. Your indicators are still there. It's just the market. So this would be a time to consider closing your spread and rolling down for a bull put or rolling up for a bear call. But remember, if it wasn't based on market conditions, as we're looking at with CMG, it's just going bearish. We were wrong on the direction on the stock. If I'm in a bull put on CMG and the stock turns bearish and my technical indicators change, simply rolling down to another bull put might be like trying to catch a falling knife. I may have to adjust that spread and then adjust the next spread. Okay? But what do you look for when rolling the spread to different strike prices and perhaps further out in time? You might be able to use the same expiration you're in right now, but depending on the cost, it's not going to happen. So what do? You know you have to close the spread to roll the position first. So take your loss for losing the spread and find a new position. Okay, remember, we initially took in a credit of 75 cents for the 1st of September expiration. The cost to liquidate both legs right now would be $205. So I buy to close my 300 put, I sell to close the 295, the debit I pay is $205. I keep the 75 cents I was already deposited in my account, so right now I'm at a loss of $1.30 total on this position. So I need to find a new bull put spread. If I think this is just a market hiccup and my stock is still strong, with a credit of at least $1.30 to break even. But you know what? I'm still opening a bull put credit spread. It still has to match my trading plan. So I need a bull put spread that offers at least $1.30 net credit now to break even, but I still want a 75% probability. I still want perhaps a 2 or 3% range out of the money, or a delta below 0.25. Okay, so very quickly I just go to Power Options, I go to the bull put credit spread search, and I look for any expiration dates out in time below 60 days if possible that have us on CMG with a 75% probability and $1.30 net credit. Okay, so we have 6 or 7 opportunities that came up. So for example, we could roll to a different spread here with a net credit of 220. Here's some at 180, so I'd still be making 50 cents on the position if this expires. 145, that would only be a 15-cent profit. I have to take into account the loss on the position as well. Now these returns are the static returns, but I have to remember that I'm taking 130 off of each of these net credits. But look at the time frame. October, 57 days out. September 15th, 22 days out. September 29th, 36 days out. There is nothing in the September 8th or the September 1st series which gives me the probability I want for the new trade with the net credit of $1.30. So now I'm going from maybe what was a 14-day trading plan out to 22 days, out to 36 days, or out to 57 as well. Okay. I thought I had kind of explained this. Maybe I didn't explain it well. Okay. Chang writes in, says, why stick with the same stock? Why not close the leg and make up the loss with some other stock? That was option number 1. Okay, this is option number 2. Option number 1 was liquidate the position, take the loss, and go into a new play. You would have had a $1.30 loss on this position. Now you look for a new stock which matches your criteria, because this one has now gone against it. Option number 2 that we're talking about here, rolling down and keeping the same bull put spread, is if you feel the drop that occurred in the stock was not related to the strength of the stock, but an outside occurrence across the market. Remember 2 months ago, a month and a half ago, can't remember if it was a Thursday, but all of a sudden the NASDAQ and the techs dropped about 5 or 6%. 4 days later they were back exactly where they were. You know, it was a hiccup in the market, some fear about the tech itself, the tech industry. You would have seen strong stocks, Tesla, BABA, Apple even, take almost a 3 or 4% hit. I was in ATVI, Activision. It took a 3 or 4% hit. 4 days later, it went from about 64 down to about 61 or $60.80. 4 days later, it's back at 63.80. Okay? So if you think it's just the market, you could just stay in the trade, Chang. You could have closed it out if you thought it was because of the stock, because your technical indicators on this stock went from your initial sentiment on the spread to a negative one. Exactly right. I was bullish and my stock is now bearish. I'm out. Option number 1, liquidate it, look for a new position to make it up. But if you think it's not related to your stock, that it was an outside market influence, and this is still a good position, rolling it down might not be a bad idea. I'm showing these as the opportunities that investors use. At the end, I'm going to review all 7 again and talk about, in addition to the pros and cons, which ones I prefer and which ones I don't. Okay, but we're presenting the ideas of rolling a position. This is more commonly used than you think. 9 times out of 10, when I get a call from a customer who's in a vertical spread that has moved against them, their first question is, well, this spread went against me. I'm at a 60% loss on the spread, or 60% of the maximum loss. I was thinking of just closing it and moving the whole spread down and out 3 weeks out in time. That's the first thought. There's nothing wrong with that. Why is that the first thought? Because remember, most options traders started with covered calls or maybe cash secured naked puts, level 1 trading before they moved into spreads. What's the common approach to close a covered call that's moved down 3 or 4% and is losing money? Roll the call down and out in time. So why not do that with a spread? Well, exactly as you mentioned, Chang. If my technicals have changed, and in this case they have, This is an opportunity. This is one of the adjustments, not necessarily the one I would use, but this is one of the adjustments. Okay? But I would only use this if I thought it was based on an outside market influence and my stock was still strong, or if I'm in a bear call spread, there's sudden good news that came out on the market and everything jumped up, but I'm still bearish on my stock and think it's poorly managed, I might roll my bear call spread out to higher strike prices, better probability, and probably further out in time. Right? So that's the trade-off. When you just simply roll the position, you roll the spread to different strikes and stay in the strategy you're in, you're going to have to go further out in time to make up for the loss you're taking. And if your sentiment has changed, Chang, absolutely. Liquidate, option number 1, and then do your search, find your new positions, and make up for that over time. All right. Number 3, roll the short leg down 1 strike. It can be used in all 4 of the vertical spreads, bullish, bearish, debit, or credit. Okay? This is one of the reasons why I use a 2-point spread when I open my positions, or 2-point spreads, I should say, or a strike between. So I have $1 strike differences, I'll use a 2-point spread. Again, if it offers 250 strike differences only, I'll use a 5-point spread and so on. Now, if it can still be done at a profit, and that's the key. Sometimes this works, sometimes it doesn't, but it is an opportunity. So here's what I'll do with rolling 1 leg. Rather than adjust the whole spread, or having to move it out to 57 days out in time or 36 days out in time, I keep the same expiration. This morning we could have bought to close the September 300 put at 430. Stock's bouncing around 301. It's threatening my short put strike. Would have cost 430 to close the 1 September 300 put. And then I'll sell to open a 297.5 put for 380. So my debit to do this adjustment is 50 cents. Sean mentioned earlier, it's going to cost you to roll the leg one way or the other. Absolutely it is. And in this case, it's going to cost me 50 cents. But remember, and as Chang mentioned, I would only do this if I felt it was an outside market condition not related to my stock. I'm still bullish on the stock. Something outside influenced the market pullback. And in this case, I'm still bullish. So I pay 50 cents to roll to these 2 options. Buy to close my short 300, open the 297.5. I pay 50 cents. Maybe I get a little better at midpoint, but I pay 50-cent debit. I took in 75 initially, and that was deposited directly into my account. So where am I now? I still have a net credit of 25 cents on the entire trade. Now, the monetary requirement, the maximum risk, drops. Because now I'm in a 2.5-point spread and not a 5-point spread. So I just freed up some margin. I give myself more cushion. So even if the stock, we were talking about being at 301, now my pivot point's at 297.5. If the stock stabilizes or even falls down to 298, I might look to manage then, but I'm still in a profitable position. This is one of the reasons I initially started doing that back testing we showed yesterday with leaving a strike between and using 2-point spreads or greater. Now sure, if you did a 1-point spread and your security offers 50-cent strike differences on the weeklies, yeah, you could roll down to the 50-cent one. You'll probably take a net credit of 10 cents down to 3 cents. Might still be a positive net credit. Depending on the number of contracts you're doing, that might not work. This I might be okay with, depending again on the size of the contracts. It's a 5.3% return. But remember, if I liquidated right now, I would take a loss of $1.30. If I rolled out with number 2, option number 2, and rolled the spread down, I have to go 22 to 36 days out in time. Here's still 7 days left. More cushion on the position, still a positive net credit. Now, Sean had mentioned earlier it's going to cost money to do that. We saw that. So the goal here, the way this works, number 3 works, of course, is if your debit to roll to the lower strike is still less than the initial net credit. Sean's absolutely right. If it's greater than the net credit, this won't work. In this case, real world prices, I could roll down the CMG spread 1 strike. Get a little bit more cushion, still keep a positive 5.3% return instead of taking a $1.30 loss on the trade. Okay? All right, so rolling down one strike, pros and cons. You increase your probability, you get a lower delta that we look for. It's still a positive return if the stock stabilizes, and hey, lower margin. Remember, I started with a 5-point spread. By rolling down to a 2.5 spread, now I only have to put up $2.50 per contract that trade. Some of that margin's freed up. What could I do? I could open another $2 spread now on a new bullish stock to try to help hedge that, or keep generating premium as we like to do. One commission to roll. Okay, so when I roll a leg at my brokerage account, it's one entry, and they charge me the standard option commission plus about 50 to 60 cents extra. Remember, if you liquidate the spread and roll it down, you can roll each leg, but you're doubling the commission cost. So commissions will come into play, but it's just one commission to roll with maybe a little bit extra. I'm not doing 2 commissions to roll both legs or to close the spread and open the new one. What are the cons? Well, I could still lose $2.25, as Chang mentioned, if the stock continues down. Again, this one is used if some outside influence other than the strength of the stock itself brought the stock down while you're in the trade. Roll it down one strike, give a little bit more cushion if you still have a positive return. Yes, you could still lose if the stock continues down. You could still evaluate other management at that time. But again, even the stock drops to $2.98 from where it is now at $3.01. If I stayed in the original position at expiration, I'm going to take a $2 loss, close to 47% again. If I roll down one strike and the stock falls to $2.98 in the next 7 days, I'm still at full profit of 5.3%. I'm taking a losing trade to a winning trade. That's why I would do it. All right. Number 4. This only works with credit spreads. Doesn't work with the debit spreads. Okay? But number 4 is close the short and leave the long open. This is if you're very aggressive and if your sentiment has completely changed on the stock. You found 5 or 6 bullish positions. All of a sudden, 4 days into the trade, you realize this one that you're in right now has gone completely bonkers and opposite of all the other 4 positions, 5 positions that you opened. It is bearish, and you think it's going to continue to be bearish. Bad news came out, something you can't control, but it's related to the stock itself. And now you've gone to complete bearish, okay? Why is this not possible with a debit spread? Well, let's consider this. Bull put that we're in right now, we want it to be up here. Same profit and loss chart as a bull call. Well, if the stock turns and continues down, if I buy to close this short, I'm now in a long put that profits to the downside. But in the bull call debit spread, you have the same risk reward profile, but if you close the short call, you leave a long call open, which will continue to lose money if the stock moves down. You don't do this one with a debit spread. Okay, this is where your sentiment has completely changed, and you're now bearish, but you still have time. 5 days to 10 days or more out of time. You still have 5 to 10 days to expiration, and your sentiment on this stock has completely changed. So buy to close the short leg, and it's going to cost you. This is where it hurts. It costs you. But you leave the long open. In a bear call, I'd close the short call if I was bearish, but good news came out. It looks like there might be a buyout coming out. I'll pay to close the short call, leave the long call open in the bear call credit. If I have time, this is not something you can do with 1 day or 2 days to expiration and the stock had started to move against you and your trigger points hit on those last 2 days. This is not something you would consider doing unless you're extremely aggressive and extremely bearish, okay? So what do? I buy to close the buy to close the short 300 put for 430. Now I keep the 75-cent net credit, so I now own a 295 put for 355. So that means my break even is at 291.45 on a stock that's bouncing around between 301 and 299. This isn't exactly the best one to do. But again, if your sentiment has completely changed, you've got time, and I'd say really 10 days or more, and you think this stock is turning and is going to drop in price, you could potentially do this. Buy to close the short, leave the long open, only for credit spreads. Debit spreads, it wouldn't do you any good. Okay? Could you do this with a debit spread if the stock fell, but you think it's going to come back up? Yeah, but you might get more profit on the long call, but in that case, it'd be better just to leave the bull spread open or the bear put debit spread open rather than closing the short if you think it's going to recover. Okay? In this case, we've completely changed sentiment. We think it's going to be aggressive bear when we thought everything that we looked at when we opened the position was a bull. Now we think it's an aggressive bear. Buy to close the short, leave the long open. Well, right away we can see the cons here. Now what are the cons? Well, if the stock drops below 295, let's say it goes right to 295. If it's at 295 or anywhere above, you're going to have the maximum loss of 355. Less than the 425 you would have taken if the stock was below 295 at expiration, but much more than just liquidating now and taking a loss of 130. Okay? Not quite 3 times as much, but almost close to it. The pros are it gets you in a very bearish position if your sentiment is completely changed. You have the potential for large profits if it does go aggressively bearish or aggressively bullish in a bear call where you bought to close the short call. The cons, we're in a long call. It's speculative at best. We're in a long call at 355 cost. In this case, is about 8%, 7% out of the money. Okay, so we have a higher probability of losing the 355 and a lower probability of profit. But again, it's an idea. If your sentiment has completely changed or market conditions as a whole have completely changed when you're in a bullish spread or a bearish spread as well. Okay, so that's another one. Number 5, creating a condor or a butterfly or a broken wing butterfly. All these are kind of similar. I don't prefer to use the butterfly approach when trying to manage a spread. I'd prefer to use a condor. It's a very simple process. And the idea behind it, what is sort of the conditions that would cause us to do this? The stock has fallen against us. Again, from outside market influence, not necessarily weakness in the stock. Another thing that can be an outside influence that happened to me recently is I was in a bullish position on a stock, a collar spread actually, on a particular stock, and no news came out on the stock, and its earnings weren't for another 26 days or 18 days, I'm sorry, 18 days away. But what ended up happening is that a competitor of theirs completely failed their earnings and dropped about 18%. So all the stocks in the industry sort of pulled down 3 or 4%. My stock was the leader of the group. It was one of the top 2 in the particular industry, that sector that it's in. Okay, but bad news is going to bring everything down. It dropped 3.5%, 4%, but it's still a strong stock, still leader in the industry. It ended up recovering 4 or 5 days later. But again, I'm in a bull put, let's say, on that stock. It pulls back because of an outside influence, but I still think it's strong. But maybe I'm concerned the stock might go right to my short put or my short call a little bit below it. I want to stabilize it. I want to get a little bit extra credit to move my break even further down. Okay, so I can open the opposite to create a condor. And you only do this if you think the stock will stabilize. Puts you in a position where you now have 2 ways to lose. But it gives us a credit to help our break even, but at the same time, it's going to double the margin most likely. Okay, why do I say that? Well, we've got our bull put. We've got the 300 strike. The stock's dropped down to 301. I look at the position and I say, well, I think it's going to stabilize and move back up. It's probably going to be in this range I thought, 304 to 308, somewhere in there in the next 5 days, next week, or 7 days to expiration. So I'm going to look to open a condor by opening a bear call. I sell to open the 310 call at 255 for September 1st. And I open the 315 call at 155. I get a new net credit of $1. So my total credit for this position is $1.75. I want to keep the same expiration, and I'm going to keep the same strike difference. Okay? So What did this do to our initial bull put? Well, it moves our profit line up. We went from 75 cents maximum profit to $1.75. Okay, so we moved our window of profit up. We also lowered that break even. With the 300 strike, the 75-cent net credit we originally received on our bull put credit spread would have put our break even, of course, at $2.9925. Now I've got $1.75. Okay, so now we're down to $28.25 for our lower break even. But we also create an upper break even. The stock's fallen down in price. We want to sort of give ourselves more cushion. If it keeps threatening the bull put side, we sell the opposite. So if it was a bull call debit, I might open a bear put debit and have a Condor debit. I could also open the bear call and have an all call Condor. There's different ways you can mix the Condors in. This is an iron Condor, where I've got a combination of a bull put credit and a bear call credit on the same stock. But it could be an all put Condor. I could open a bear put debit instead of the bear call and have an all put Condor. Okay? So that's the advantages of this particular position. We increase this potential profit. We give ourselves more cushion to the downside if the stock keeps hovering around this $299 to $300 range. But we have given ourselves two ways to lose. We've created an upper break even in addition to where we had the lower break even. So the net credit here is increased. We get $1.75, which, by the way, might be a 53.8% return. How? Well, depends on your broker. I opened a bull put credit 2 days ago. I go into my broker now and open a bear call credit. Well, they're going to see that maybe as two different spreads. But your broker may allow you to add wings to your bull put credit spread. And if you add this, they might read it as an iron Condor, where they're only going to charge you the margin for one side of the spread or the other. Because you can't lose twice at the end. At expiration, you cannot lose twice. Now, if it moves up above 310 between now and expiration and you roll and take a loss on the bear call and then it falls back, yes, you could lose twice. But at the end game, you can only lose on one spread or the other. Your brokerage knows that. So they might only charge you $5 margin for either the bull put you were already in or the new bear call that you're in. But that's a 5-point margin with a $1.75 net credit. So now your margin requirement against the maximum risk, you have $1.75 against a $3.25 maximum risk, 53.8%. Okay? That's if your broker does that. My main broker, the one where I have most of my accounts in, if I enter this at a separate day, they look at it as two separate spreads. So my margin goes up to 10 points. That's one of the cons. It might count as two margin requirements if you convert it to a Condor or a butterfly. And it gives you two ways to lose. But the other pro is that, remember, it increases that lower break even. It gives you more cushion to the downside and more potential profit if it stays between the strikes. So if something happened outside influence against my position, maybe I'm not as bullish as I was when I opened the bull put credit spread, or as bearish as I was if I opened a bear call credit spread. But at this point now, I'm thinking the stock's going to stabilize, but I want to give myself a little bit extra oomph. I looked at it as a new position and said, I think it's likely to stay around 300 or just above it, but I don't think it's going to breach 310 or 315. So let me open the opposite side, create a Condor to give myself a little bit more protection just in case it does fall down below 300. Even if it goes to 299, it'll cost you $1 to buy that 300 strike back, but you'll still have 75 cents of profit that you originally expected. Okay? But if the market's going into turmoil, black swan event happened, the market as a whole pulled down and is threatening your bull put, Condor might be good, but you still want to get out of that bull put in that case. If your sentiment has changed on your stock, get out of the bull put with one of the other options. This works if you think, again, it was an outside influence, you think the stock's going to stabilize, legging into a Condor, get some new premium, increase the potential profit, but you might double the margin requirement, and now you have two ways to lose. Instead of what I sort of just mentioned, opening the Condor on the position, instead of just liquidating and rolling down the bull put, which Chang mentioned earlier, why do that? Why just not get into a new position? If my sentiment has changed on the stock, not related to outside market influence, I was just wrong. Close the spread and do the opposite. So it's just like adjustment 2 rolling the spread, but now I'm going to close my bull put credit spread and I'm going to open a bear put debit or a bear call credit on the same stock. As before with adjustment number 2, you might be able to use the same expiration if and only if the new net credit is greater than the cost to close the initial spread. We'd have to pay $2.05 to close our bull put on CMG. We keep the 75-cent net credit, so our loss is $1.30. So now I need to find bear calls on CMG with a 75% probability and $1.30 net credit because my sentiment has completely changed. Using that, the only ones available are the October series that are 57 days out in time. Okay? To be honest with you, in this case, I opened a 14-day trade. My sentiment has completely changed. I think the stock has gone bearish. I don't want to take what's a 47% loss now on CMG and risk taking it to a 100% loss if it continues down. What am I going to do? I'm probably going to close my bull put, but rather than roll 60 days out to the only bear calls available that offer that $1.30 net credit with the probability I want, I'm going to do what Chang said. I'm just going to close this spread out and I'm going to go ahead and look for other bull put spreads that better match my criteria. But there may be opportunities to stay within the same expiration 9 days out. September 1st, 7 days out really, 8 days we'll call it. But I might be able in some situations to keep the same expiration or maybe just go to September 8th, which is about 15, 16 days out in time in that scenario and get $1.30, $1.40, $1.50 with still having a 70, 75% probability. That's what's possible. But if I'm going now 2 months or more out in time just to manage it to turn a 75-cent loss, I'm sorry, taking the loss of $1.30 to make 40 cents in 60 days, you know what? I'm probably going to do one of the other adjustments. But consider this an idea. Change the tactic. Sentiment has changed. Don't just simply roll the bull put once you view it again as a new position. Just because you like trading bull puts, just close it and look for a better position. Or if you can find a position that's the opposite now that your sentiment has changed, close your bull put, see if there's a bear call there that gives you the credit, turns the losing trade into a winner, still being only 7 to 15 days out in time, not 60. Okay, I wouldn't do this in this scenario, I'll be honest with you. All right, so of course, pros and cons. Closing in the opposite. The pros, you still might have a profitable trade. And you're now pointing with the proper sentiment because you've decided that your stock has gone from bullish to bearish or from bearish to bullish. Okay, so you do the opposite. The cons, we're going to have to add time. Most of the time, 90% of the time I look to do this adjustment, I have to add more time than is in my trading plan for usually doing the spread positions. And you still can lose or still might have to manage the new position if the stock reverses. What did we talk about at the very beginning with option number 1? If you analyze the stock chart with fresh eyes, thinking you're not even in a position, and you say, I just don't even know where the stock is going to go next, well, that's pointing me back to adjustment number 1. Just get out of it and look for new positions with better sentiment. Okay? There were ways we saw to turn a a losing trade into a profitable trade. We're going to review all those in a minute with the sentiment that I have in mind for those when I look at my positions. But first, I want to talk about adjustment number 7 for credit and debit spreads. Remember, adjustment number 4 is the only one you can't do with a debit spread. All these adjustments you can do on either the credit or the debit. Number 7 is the pendulum adjustment. Now, most of the adjustments we saw are used before the short option goes in the money. When your trigger is hit, your probability shifted, your delta changed to a range you wouldn't enter the trade, your technical indicators, stock falling below the SMA 20, stochastics, whatever you use, those were your triggers, but the position was still right at or just out of the money. Okay, but sometimes you wake up in the morning and you had a trade that was still out of the money, and all of a sudden you wake up in the morning and notice that something happened with the stock and it is between your strike prices. News came out related to the stock itself. Your sentiment has changed. You close now and you might be taking a 50 or 60% loss of what you expected. Not the 100% loss, but you may be close to that 50 or 60% loss. Now we talked about just now closing and opening the opposites trade if your sentiment's changed. When the stock falls between the strike prices, you can adjust one leg only, not the whole spread. Not having to go 60 days out in time, keep the same expiration, but you may be able to just roll one leg, turn a bullish spread to a bearish spread with just a minimum commission. Or vice versa, I could create a bearish spread to a bull spread by just moving one leg. And this is what we call the pendulum adjustment. And I'm going to use power options to illustrate this rather than on the slides. And I'm going to show you some other things as well. Let me refresh my page here to make sure we're all looking at the same thing. Fantastic. Okay. I know it hasn't shown up yet. Just give me 1 second. All right. What we're looking at here is the portfolio tools on power options. And you see here I've created a, a portfolio called opposite spreads from presentation. There's our CMG position. Look, it's looking better now. It's at 305.71. Okay. So again, we would have done this. We're still at a loss of 650, which is half the loss we started with. Okay, but that's fine. One thing I wanted to show you, though, of course, is here's our other position. On Tuesday, we saw Alibaba, BABA, at around 171. The potential bull put spread that came up on the power option search was selling the 165 put and buying the 162.5, I believe. Might have been the 160, I forget. But we did a bull put credit spread. What if instead on Tuesday I had entered a bear call credit spread on Alibaba where I sold the 172.50 strike for 205 and bought the 177.5 for 85 cents. Okay, here's my bear call credit spread. It's a high return. Okay, we would have taken in $1.20 on a 5-point spread. This is 10 contracts. I'm going to change it to 1 for our examples just so the numbers are easier to read. All right, there we go. So $1.20 net credit, high potential return, but Alibaba's at 175-ish, 176. My sentiment has changed. I opened a bear call credit spread, but the stock actually moved up. It's now trading between my strike prices. I could close this position and open a bull put spread now, maybe at the 172.5, 170 or something along those lines. But rather than closing this whole spread, paying the commissions to close the spread, and then paying commissions to open a new spread, or having to roll 2 legs, like just buying to close the short, which only costs 1 commission, the pendulum adjustment, I'm going to sell to close my long call, swing it down, and buy to open the lower strike call. So it's a 5-point spread here. I'm going to sell to close the 177.50 call and then buy to open. I'm just going to roll the call. I'm going to keep a 5-point spread. So we're going to go down to 167.50. Is this going to cost a debit? Yes, it's going to be expensive. Is it going to work? I don't know yet. I want to do it on the fly. I haven't analyzed this. So we go in September now. Bought the 175 call, so I'm going to click on that to add it back in. We're going to sell to close the 177.50 call. 231 to 238. Okay, so not much on bid-ask spread. Let's be nice to ourselves. Let's just call it 235 to keep the math simple. Okay, so I took in a net credit of 120. I'm paying 235 back to buy to close the 177.5 call. Now I'm going to buy the 167.5, keeping the 5-point strike difference. Maybe I could buy the 170. We'll take a look at that too with the pendulum. But I'm going to pay 910. I'm going to call it 905. Since everything else is with 5 here, I'm going to call it 905. I know that's cheating, but we're going to call it 905. Okay, so what am I paying? I'm paying, just for this transaction alone, a debit of 670. Right away I can tell that's not going to work. Okay, why not? Well, the debit here between these two is 670. Okay, so I pay that back into the position. I originally collected a $1.20 net credit, which was deposited in my account. So that lowers the cost basis in the trade to $5.50. It's my debit, $5.50. But I've only got a 5-point strike difference. So the most I can get back now that I've converted with one move my bear call credit that was failing to a bull call debit spread. Well, it's only a 5-point spread, so I can only get 5 points back if the stock is above now. I have changed a bull to a bear, or a bear to a bull with one roll, one move, rather than closing the whole spread and opening the opposite. Did one move. But in this case, it doesn't work. This new cost basis, the new debit that you'd pay to swing the long option, and you always swing the long option. You don't swing the short. You leave the pivot alone in the pendulum. You roll the new one. The new debit minus the initial net credit has to be less than the difference in strike prices of your spread. This does work, by the way. I have seen this work a lot, usually when it's right between the two strikes. If this was at 175, the 177.50 I might only get, let's say, 210 for. And the 167.50 with 7 days to go. If it's right at 175, let's say I just paid $8.50 for it. Actually still enough? No, I'm sorry, I meant, let's say we got $2.50 for this. Yeah. Okay, so I'm just showing this as an example. We took the original bear call credit, which was here, and we took the long option, swung it down to the new strike. Sometimes you may see that get a profit. What's the advantage? I kept the same 7 days out to expiration. Now that my sentiment's changed, I moved a bearish position to a bullish position with one commission, or maybe one plus commission, because you're just rolling one leg. Again, it doesn't work all the time. I used BABA as the opposite example because it was between the strike prices. That's when it works best. Okay, when it's still not below the short option. You know, below the short put or the short call in a bull put credit or bull call debit, or above the short call in a bear call credit, or above the short put in a bear put debit. If it's still out of the money, the pendulum you wouldn't use. But if you just wake up now and suddenly the stock is right between your strike prices, a little bit below your short option, before panicking and just closing and taking the loss, if your sentiment has changed because of bad news, evaluate the pendulum adjustment. One swing of the long option is going to convert you from a bull to a bear, or a bear to a bull if your sentiment has changed. Save a little bit on the commissions, and if the stock continues down, you're still in a profitable trade. In this case, I was in a bear, my sentiment changed, so sure, I'm only making 2%, but if the stock continues up, I'd be closer to 100% loss on the bear call. If I just move the spread up in strikes, I might have to manage that new bear call if BABA continues up. So one swing, one commission, change a bull to a bear to a bull, might be able to get you a profit on the position now that your sentiment has changed, and not having to go 57 days out in time, as we saw with repairing or doing the opposite, trying to make up that $1.30 net credit, or the $1.30 loss, I'm sorry, that we would have taken by closing the spread down on the CMG bull put that was wrong. Okay. Sean says, it sounds that this adjustment number 7 is your preference. Well, it's my preference, but again, remember what I was saying, Sean. I like to use this one. I really do. But it really only works in that one scenario. All the other scenarios we talked about for ideas for management and triggers are if the stock's threatening your pivot, is threatening your short option. Okay? This works if it's been breached. This is an adjustment if it's been breached. If the stock is above your short option, between your strike prices, I would never do 7 in the case we saw with CMG, where the stock was just above the 300 strike, but we're getting close to that price as well. Okay? Okay, Chang says, it becomes often hard to go through this during market hours with fast changing numbers. Yeah, I understand that. You know, I'm showing some different numbers and some different premiums. This is a whole different position. I wanted to show this position on BABA with the bearish strategy because it was threatened for the pendulum adjustment. I wouldn't do the pendulum adjustment again on the CMG position we were looking at. And that's why I wasn't using power options to show the CMG trade, why I had the slides put together, simply because I was trying to keep it as even as possible. But one other thing I wanted to show you real quick, let's see if there's other opportunities available. Now this one's still good. I'm going back to the main portfolio. As you're tracking any position in the power options portfolio, we can go to position actions and position analysis. And I don't know if it's going to have any for us. No, it doesn't. Unfortunately on this one, what it doesn't show me, because it's been breached and the pendulum adjustment doesn't work. But let me try the other position. When you're tracking your different positions in the power options portfolio, and you go into our position analysis view, this one didn't either, because it's profitable again. When it was there this morning, I'm sorry it was. But what you'll see is you'll see potential rollout opportunities. So we'll do the calculations for you. And earlier this morning on the CMG trade here, it did show me the loss to liquidate the position. It showed me the potential for creating a Condor with the 310 and 315, which is what I pulled up. And it also showed me opportunities for rolling the spread down. Okay, so some of these ideas we're talking about here for rolling and adjusting your vertical spreads are already programmed into power options. So when you're tracking your positions, rather than going through the math manually yourself, you'll be able to see one or two rollout opportunities when your spread's being threatened with all the math done for you. You can compare the before and after pictures side by side, see if it matches, and of course if you have a different analysis or a different adjustment you wanted to use that didn't appear in the rollout opportunities, you can do what I just did. I can go to what if calculations, it pulls up my trade, and then I can manually see, well, is converting a bull to a bear, doing a pendulum adjustment like I just did on the BABA bear call that was losing money, would that be the one to do? Okay, so you can analyze them here. But when you see them in the rollout opportunities on the position analysis page, you'll be able to compare them side by side. And of course in the portfolio what we do show you is the position as a whole when you're looking at this analysis view on our tab views. So this shows me the original expected max profit and return, my current liquidation value, and where my position would stand if the stock stays at the same price to expiration. So I immediately have access to full evaluation on my position, where I stand right now, what was my initial expected return, and if the stock stays where it is, what is my expected loss at expiration as well. Okay, so going back to what Sean said a moment ago, he said it sounds like number 7 is your preferred. And again, it is in that situation where the stock's between the strike prices. But believe me, I don't hope to open positions, credit or debit spreads, where I'm thinking the stock's going to fall between my strike prices just so I can use the pendulum adjustment. Okay, that's not what I'm going to do. But which is best? Well, as Chang just mentioned, it depends on your sentiment. It depends on market conditions, what's available. As the market conditions change, the price of the options change. What are they giving you for adjusting the position and the prices? Okay, so which is best? Liquidating to avoid 100% loss. Option number 1, never a bad idea. I'm at a 38, 47, 49, 52% loss on the position. My sentiment has changed, or I'm just not sure what the stock's going to do next. I don't have a strong feeling after I look at the chart with fresh eyes. Taking a smaller loss, maybe only wiping out 3 or 4 trades in a while, instead of 7 or 8 because the risk-reward ratio is not a bad idea. Rolling down the entire spread can work, but we saw in order to do that we might have to change our trading plan. If I'm doing weeklies, or my plan is to go 14 days out in time, and I look to roll down and stay in a bull put or stay in a bear call, I may have to go 30 days, 35 days, 57 days out in time. Might not be worth it to just roll down. As Chang mentioned earlier as well, hey, if your sentiment has changed, go ahead and close it. Okay, why rolling down the spread can work if it was outside market influence, you still think it's a good way, and you want to stay bullish on the position, it's one you could do. Rolling the short leg gives you the benefit of only paying one commission like the pendulum adjustment, And again, why I always leave a strike between my differences, I'm sorry, my strike price between the cost basis of the position when I open a spread, so that I can potentially have that opportunity to roll down the one leg. Only one commission, I stay in a bullish position. Why do I do number 3, rolling the short leg? Well, it's because something outside of the market influenced my stock. I'm still the original sentiment when I open the spread. I roll down one strike to give me a little bit more cushion. Not always available, because sometimes, as we saw a profitable roll down to one strike. Sometimes it might not be profitable, meaning you'd lock yourself into a loss. The debit would be greater than the initial net credit, and it won't work. Okay, closing the short and leaving the long open. You really want to have a lot of time remaining to expiration, 10, 15 days or more, in order for that to work. Also, in order for that to work, your sentiment has to be completely changed. What you thought was a neutral to bullish position, whatever changed in the market, you now think it's an aggressive bear position. There's a lot of bad news or potential bad news coming out. That's when that one works. But remember, your probability of profit is much lower. You increase the break-even, farther distance to the break-even. Converting to a Condor, butterfly, or whatnot, nice premium. Lowers the break-even on the position, gives you more cushion, might give you 2 ways to lose, and at the same time might cause 2 margin requirements based on your broker as well. Okay? All right, now close the spread and do the opposite. Your bull put's threatened, you close it down, and you open the opposite position. I close my bull put, I open a bear call. If the sentiment is changed, what we talked about before, if I don't know the direction, I can't think of a new direction, just get out of the position, look for a whole new stock. Why stay in the same stock? But if your sentiment has changed, you've moved to bearish now, you can find a good credit to cover the loss in the position, the sentiment has changed, then there you go. Okay? We can roll that down in price, close our original spread, and roll the opposite. All right? And then the pendulum adjustment, I like it. It's fun to use. Only works when the stock is between the strike prices, is harder to find as well. Okay? All right. Now, of course, I just want to remind everyone, and remember, if you haven't done so yet, we only showed a little bit of the tools today. We showed some of the portfolio features and showed the profit and loss chart. Yesterday we showed the, my apologies, we showed the criteria that we use for the stock itself and for the spreads themselves using the Power Options search tool. If you haven't done so yet, remember you can go to poweropt.com at any time and start your 14-day free trial. All that's required is name and email address. We have different subscription levels after that. The end-of-day data is $40 per month. 20-day delay data gives you access, of course, to the search tools for all 23 strategies, the tools to track and manage your positions. Well, that's $60 per month. Real-time, we do offer a real-time service. So every time you refresh a page, you're getting the numbers and calculations at that very instant. It's $120 per month. And then, of course, we offer historical data that interact with our tools, a historical search in the different strategies, historical search by symbol and chain, and our data goes back to April of 2006. Okay? So those are the tools that are available on Power Options, of course. Today's presentation is recorded, as most of them are, and all of them this week have been, and we've been talking about our spread positions. We will let everyone know when today's webinar is posted to the archives. If you do have questions at any time, remember you can send us an email to support@poweropt.com. You can also call us toll-free if you live inside the U.S. at 877-992-7971, or of course just at 302-992-7971. Of course, there's contact links at the bottom of every Power Options page. One last thing I wanted to mention, of course, here. At any time, of course, you can go to our webinars page. There's a variety of different webinars that are available to view on the Power Options tools, the various option strategies, our 2 previous presentations on spreads here, debit spreads versus credit spreads, and how to be successful with spread trades, already available in the archives. And this, of course, is a public page. You can access it at any time. You don't need a subscription, and you don't need a trial even to access the webinars. You can go to poweropt.com/webinars.asp, and access our presentations on other strategies in addition to the first two of our four-part series on spreads, and this is part 3, and you'll be able to see that later today around 4 p.m., 5 p.m. Eastern Time. There's other things here, options concepts, weekly options, of course, is a discussion there, managing your broken stock position, implied volatility, the double-edged sword, Greeks, and why you may not need them. A lot of different education here on options education and more. And of course, we also can follow us on our YouTube channel. And at any time on this page, if you click Watch Live Webinars, you'll see the next one's coming up, of course. Tomorrow at 4:30 p.m., part 4 of our series here on spread positions. Every Friday at 4:30 p.m., I host an open discussion, open forum presentation where we just take attendees' questions on the fly. This week, however, we're devoting it entirely to spread positions and spread positions only. Okay, so we'll have an open discussion. It'll probably go again from 4:30 to 6 p.m. Usually it's 4:30 to 5:30, but I think already 70 people are registered for that webinar. But again, tomorrow at 4:30 p.m. Eastern Time, just after the market closes, we'll be able to access that. So the reason I'm showing this mainly is Don had commented in and he had said, I can't follow you, you're moving too fast. I do apologize for that. His webinar lasted 1 hour and 28 minutes. There's a lot of detail to cover. And I know a lot of numbers were thrown at you. And trying to say which one is the best one, well again, there is no best one. There are ideas to manage your spread positions to convert a losing trade to a winning trade and to keep you from taking potentially a 100% loss, which might wipe out 10 or 15 trades. The market conditions are going to dictate which adjustment might work best for you, in addition to your own personal sentiments and your risk threshold. I'll admit, very rarely, I can think of 2 times in the past 2 years, 3 times, I'm sorry, in the past 2 years, where I did that adjustment where I bought to close the short leg and left the long open because my sentiment had changed and I was aggressive in the other direction. 2 out of 3 times it worked. The 3rd time it didn't. I took a loss that was equal to if I just would have liquidated the position. But buying to close the short and converting a spread to just a long call or a long put, I've only done it 3 times. 2 times it worked to a profit where the stock continued down, where I would have had a 100% loss if I stayed in the spread. 1 time I took a loss that was equal to maybe a little bit more than the maximum risk I would have taken on the spread. And had I left the spread alone, it would have only been about a 20% loss on the position. So that's the trade-off. But my sentiment had changed. I follow my trading plan. I follow my trading rules. And that's what I wanted to share with you today. The ideas on, yes, you can take a spread that's losing. And instead of just liquidating it and taking the loss on the position, there are ways that you can adjust it to turn a losing trade into a winning trade. And we showed multiple ones. The 7th one didn't really work, and it only works in that one situation, the pendulum adjustment. But it can be very, very useful, and I use that in those situations that do occur when it's between the strike prices, where it was out of the money when I went to bed, and when the market opened at 9:30, it opened up down and was between the strike prices. I used the pendulum adjustment in that situation, then it's worked out pretty well for me. It only works in that situation. So market conditions, what premiums are being given to you by the market and the exchanges themselves will help dictate which adjustment is best. The power options tools will help you with that. As you're tracking your spreads, you'll be able to see some of these rollout opportunities already calculated for you of potentially taking a losing trade into a winning trade as well. All right, so I apologize, Don, if I went too fast. That's why I want to show you that archive page, and I sent everyone a link to the archive webinars page there so you can go through the different webinars at your speed, pause, rewind, review. A lot of them are available on our YouTube channel as well. Well, ladies and gentlemen, thank you very much for joining me today. Part 3 of our 4-part series is wrapped up. Part 4 tomorrow at 4:30. You can register for that at powerop.com/webinars.asp if you want to join us for that open discussion. And I will let everyone know via email when today's presentation has been posted to the webinars page and on YouTube as well, so you can refer back to this material also. Take care, everyone. Happy trading. Have a happy last 2 days of your trading week. I hope to see you soon. Good night.